Date the rate, marry the house. Okay, I'm sure you've seen that ad by now, and if you haven't, you're gonna see a lot of it. So today we're gonna be talking about how that concept can make sense and when that concept does not make sense. Now, let me be very forward with this. I don't think that mortgage lenders or real estate agents are trying to put you in a precarious position. But as with any advertising, there's limited space. There's limited words you can say. There's limited disclaimers. So this video is basically a disclaimer for the concept of marry the house, date the rate. Okay, so let's talk about why lenders are saying that in real estate agents. Rates jumped a lot in 2022, right? They tripled in many cases when we were at our peak, and it was jarring to home buyers. I mean, my goodness, to go from 3 1/4 to 7 1/4, holy cannoli. And it's come down since then, but at the same point, it's been a year, right? And that created a lot of fear in the market. With first-time home buyers, they don't necessarily understand that you can refinance. And when you refinance into a lower rate, okay? So the advertisements are meant to say, hey, look, this isn't your rate forever. If rates go down, you can refinance, right? The dating, it's kind of sick actually when you think about it. It's like you can trade it in for a lower rate like you would for a hotter partner, whatever, right? That's the concept of it, okay? And look, it depends on the type of loan you're getting, how realistic that is. So the first thing you guys need to know as buyers is if a lender or a real estate agent is telling you, don't worry about the payment, you can always refinance, don't worry, don't worry, don't worry. You need to have a conversation with your lender, which is, hey, the rate's high right now. If I want to refinance, here are your questions. How much equity do I need? That's a big one. There's certain loan programs where you need a decent chunk of equity. What are the costs associated with refinancing? Is there going to be an appraisal? Is there a time period that I can't refinance? Is there a prepayment penalty? Those are the key questions you need to be asking. Now, I'm going to cover this one quickly because we all know we have a lot of veterans who watch, and I appreciate you guys. With VA, you don't need to stress this. VA has the most magical refinance program called a VA interest rate reduction loan, where it doesn't matter what your equity is. Seriously. It's literally to drop the rate. Now, is it to take cash out? No. If you have a second on the property, is that going to be potentially an issue? Sure. But if you have a straight VA loan and you're just trying to drop that rate, no problem. Okay, no problem. Now, conventional. Okay, so conventional is basically you've got a VA, FHA, let's do that one first. There's streamlined refinances where there's no appraisal, so you don't need to worry about that equity piece. Both VA and FHA have time periods, meaning that you have to own the house for a certain period of time and make a certain amount of payments before you're able to refinance. And I'll be doing separate videos on those. Now, conventional is like if you're doing 3% down, 5% down, 10% down, you're gonna need equity to refinance. So do you need 20%? No, not with most conventional loans. Now, if you're jumbo, you might. Yeah, that's a tricky one there. We'll talk about that in a minute. But with conventional, you're generally going to need at least 5% equity, okay? And all of this stuff can change. And these are just to do rate and term refinances. That just means that you are refinancing what you owe now. You are not taking cash out. Okay, very important. So if you buy a house with 3% down and rates go down in 6 months, you are unlikely to have enough equity to refinance unless suddenly the values jump in that area, or if you have cash. Okay, so that can be a little bit of a predicament. Now, let's talk about jumbo real quick. Jumbo, there are programs where you can get in with a lower amount down, let's say 15, 10%, but to refi, you need at least 20, and in some cases 30. It's gonna depend on the investor. I am not saying all of this so that you guys remember it. I am saying all of this so that you know there's a lot of variables, a lot of variables. So you want to make sure that you understand with your lender if you're planning on refinancing ultimately, right? If that's the goal, ultimately, you want to know what you have to have. in order to, do it. You don't want to be in a position where, the one that makes me a little nervous is down payment assistance, because down payment assistance, you've got 100% loan to value, and there's not a conventional program that's going to do that. Refi at 100%. You're going to need equity. You're going to need equity. The only 100% one where it doesn't matter what the value is VA. Okay, so really important to keep in mind. There's a lot of factors to this, okay, and there's a lot of loan programs, so it depends on the loan program you're getting into. So once again, if someone is telling you to date the rate and marry the house, you have to say, hey, look, if I'm dating this rate, if I want to trade in for that lower rate, what am I gonna have to have in order to do that? Okay, can't stress it enough. We're going to be talking about this with buy downs as well, because there's a lot of misconceptions in the industry right now, and I want to make sure it's totally clear for you guys when you roll into 2023. Now, you're like, okay, well, Jen, I'm VA, I'm this, I'm that, and I know I can refi, so it's okay if I don't like the payment. Let's talk about that. It's okay if you don't like the payment, but you can easily afford it. It's not okay if you're thinking, okay, I think I could do this for a couple months, like we'll eat less. Like if you are putting yourself in a bad position because you think you're gonna be able to refinance quickly, this is a terrible idea. Okay, you may not like the rate, but you need to be able to afford to pay it. Okay, and just because a lender says you can afford to pay it, guys, like we don't even look at childcare unless you're VA. Like conventional loans, I can qualify you close to 50% debt to income, and it doesn't even take into consideration childcare, which is crazy in places. I was talking to someone who was like in New York, not even Manhattan proper, $1,500 a kid. We don't count that against the debt to income, right? So you guys are always going to be a better judge of what you can afford. So if you're looking at that payment and you're feeling a little, do a budget. And if that payment's going to put you in a bad position, don't do it. Don't do it. Don't do it. Buy a little less expensive or wait. I know a lender telling you to wait. Who knew it could happen? It does. But here's the thing. The key is you have to be able to comfortably afford that payment. If it's going to put you in a bad position and you're like, well, rates will go down in 3 months. Guys, it could be that the indicators are all over the map. There's people saying 5 months, there's people saying 6 months, there's people saying 3 years. No one knows, okay? So just really protect yourself. Now, questions, comments, if you want to talk about this, I'm licensed in 48 states to do mortgages. I am happy to help. I would love to help you guys. Please reach out. Thanks.